We think that silver going forward, and we think gold is in an ongoing bull market. But silver, which had an explosion last week, we dropped down to $20.40. If somebody's looking at a price chart of silver, you'd say, oh, golly, the floor just came out. It's no good. Right now, we're back up to 21.75. So we're pushing back up toward that old floor, price chart floor. Silver price versus gold is at very low levels. In fact, if you go back in history, the last 5-10 years, you'll see we're at a level now where if you start to see a turn, you're coming off of a very good bargain level. And over the last few days, we've started to see a ratio turn between silver and gold. Gold is nudged up, and silver has sort of shot up a buck and a half or so. If that continues, then that's sort of affirming our sense that silver put itself into a bargain basement situation. But silver in relation to anything in the world, probably the price of cow manure, it's lower than it's ever been in relation to that. It's relation to gold lower. It's very low in relation to the commodity complex. So either something's wrong with silver and it's no good anymore, thousands of years of value, like gold, held its value, or now it's trash, or that was a bear trap. And we go with the bear trap argument. And we think that once it demonstrates that it was a bear trap and it's reversing, you'll probably shoot back up again. And at that point, we expect silver to outpace gold on a percentage basis. 1976 low through the 1980 high. Gold went from like just above $100 to $850, eightfold move, which is it's done 2 other times in the last 50 years. And I think this is probably the 4th time coming up. But anyway, all during that upward curve in gold, that 3.5-year bull market, stocks laid at waste. They'd had a bear market in 74 and they rallied some into 75 and then just went dead through 1982. So we didn't have a stock bubble back then, but the Fed was raising rates, Fed funds rate. In fact, when Volcker was nominated in late 1979, already the Fed funds rate had gone from like 4% up to like 11 or 12% by the time he was nominated, which I think was September of 1979. And gold hit during all those rate rises by the Fed, from, like I said, from about tripling the rate from about 4% up to like 11 or 12 before Volcker even came in. Gold was still going up. It didn't care about Fed funds raising rates, nor did the commodity complex, which was following gold at that point. Gold led the commodities into that bull market. Volcker came in, he raised rates to 15% in late 1979. Gold was still exploding. In January of 1980, gold hit 850. In March of 1980, Volcker raised rates to 20% Fed funds rate. Gold had already peaked. So all during this upward curve and rate rise, and even once Volcker came in, gold said, I don't care. It was in a ballistic eightfold move. So naturally, when you finally get up to 20%, gold had already peaked 2 months before, January of 1980, collapsed a couple $100, and he raised rates in March of 80. Commodities peaked in late 1980, but at least you had an eightfold gold move and a huge commodity move, a bubble, so to speak, so that it made sense that when you raise rates, that asset category would finally say, okay, we've had our party, we've gone up eightfold, we were due for a downturn anyway. And he provided a good excuse. It's totally reversed now. We don't have a commodity bubble. We don't have a gold bubble. Gold has only doubled since 2015 low, only doubled. It's no big deal. Gold has had 3 moves in the last 50 years that constituted 7 to 8-fold increases in price. We've only doubled over the last 6-7 years. So it's hardly a bubble. And frankly, it's back to only where it was in 2011, 1920. So we exceeded that and we're hovering either side of it for the last year and a half. So gold isn't a bubble, and commodities certainly aren't a bubble, even though they like to say, oh, they're overdone. If you look at the Bloomberg Commodity Index, and go back to 2008, 2011, we're not near those highs. Yes, the Bloomberg has had a massive percent move, but it's had a massive percent gain from an extremely depressed 5 years. The Bloomberg was at levels that you just say, I can't believe it. It's like zero pricing for commodities as a basket. In October 2020, we called for a commodity explosion based on technicals. Across the board, sure enough, almost 9 out of 10 commodities exploded on a percent basis in unison. We think what that was simply that they had been depressed as an asset class for way too long, thereby suppressing production of those commodities on a relative basis. And they were set up for both a fundamental and a technical upturn. And there certainly was monetary policy to justify that, especially when Powell came in May, around May of 2020 and exploded the money supply. The excuse was the virus. Okay, fine. At that point, shortly after he started that, gold already had peaked at 2070 in the summer, July of 2020. So all during the further increase in money supply, gold didn't go up any further, but it already doubled. So gold is ahead of these events. We don't think it follows Fed policy. And here's the problem with the central bank now, as opposed to trying to compare 1980 bull market and commodities, which bust. They're not a bubble. Gold's not a bubble. The bubble is the stock market. You look at an S&P chart since the 2009 low or a NASDAQ 100, and you had a bubble you've never seen in the history of the U.S. stock market, both in terms of years of upside, percent gain, and upward curvature. So this time around, the bubble that's going to break is going to be an asset category that they can't allow to collapse. Our opinion is in January and then in February, the NASDAQ 100 was over, S&P was over. We're entering a major bear market. And most bear markets don't crash. They're arm wrestling matches. Go back and look at the 2000 bull top to the 2002 low. Look at the 2007 peak to the 2009 low. And except for October of 2008, there wasn't anything like a crash. It was all 10, 15% drop, rally, 10, 15% rally. That's what the S&P has been doing. It's not crashed, nor is the NASDAQ. You've gone down a lot. And so have all the other asset categories. And that's the other problem the Fed has. They can't yet let high yield corporate debt become a problem. That was a problem before, if you remember back in 2009. So what the Fed has done, they've stuck a pin into a bubble, but it's the bubble they can't afford to break. And so we dare them to continue. I eat popcorn and drink beer and applaud when they try to do what they're doing, because I know that if they keep doing it, they're just going to exacerbate and speed up the collapse in their bubble, an asset category they cannot allow to collapse, and the other similar categories left and right of it, muni bonds and high yield corporate debt. So what are you left with? Well, you look at gold, and right now gold is trading around unchanged on the year. That we see, and I think a lot of large asset managers see it too, guys like Ray Dalio and so forth, who've spoken pretty negatively about popular sentiment. For example, Dalio says, quit looking at the price of your stock. It doesn't mean too much, because the value, look instead at the value of your money that stock is measured by. It's depreciating rapidly. He used the phrase, cash is trash. So that other asset category you might shift into when you don't like stocks, it's not behaving well either, losing extremely rapidly, losing buying value. So you're left with only one broad category: gold, which is unchanged on the year, and silver, which just got trashed. Was the trash the beginning of something or the end of something for silver? We think it was the end of something, and it's going to slingshot back up. We need to see some more metrics, but that's our thought process. And therefore, this Fed policy issue is exactly the opposite of what they were due for a downside. Therefore, when he raised rates off the page, they finally broke. Well, eightfold move of gold, fine, no big deal. We don't have that situation now. Instead, the bubble is not what he thinks. He's trying to break the commodity complex, but the commodity complex is not over. It's not a bubble. It's got a lot more to go.